Keeping all of your money in your bank account is actually more risky than it is safe. Many people, including many of you, have tens of thousands or hundreds of thousands or even millions of dollars sitting in your bank account earning 0.4% in interest a year, which means the $12,000 you have sitting in your savings account is going to buy you less stuff 12 months from now because your savings are not going to grow as fast as the prices of things because of inflation. When you have extra money, you can save it in the form of cash or you can save it in the form of assets. Now, every financial advisor, every accountant is going to lose their minds when I tell you this, but I'm not going to categorize these cash savings accounts as investments. That way you can understand the difference. Now, when I say saving your money in cash, that means putting your money in something like a savings account or a checking account, putting your money into a bank CD, otherwise known as a certificate of deposit, putting your money into a high yield savings account, putting your money into a treasury, that means lending your money to the United States government, or putting your money into a treasury ETF, or putting your money into a secret spot, like under your mattress or a sock drawer. What you're doing here is not actually buying something that's working to grow in value. You're putting your money into a thing that's going to generate you some interest, except you're not going to get any interest when you put your money in your sock drawer. So you put your money into the bank account, and then the bank is going to pay you a little bit of interest. How much interest are we talking? Well, the average savings account in the United States today is paying 0.4% a year in interest. The average CD is paying 1.34% at the time I'm recording this video. The average high yield savings account is paying around 4%. The average treasury, 2-year treasury, is paying 3.5% a year, and a short-term treasury ETF is paying around that 4 to 4.4% a year in interest at the time we're recording this video, and your sock drawer is paying 0. Now, what you also need to remember about these treasuries and treasury ETFs is you're lending your money to the United States government. So there's two things you have to understand. Number one, because you're generating income from the United States government, this interest that you're getting here is not going to be taxable at the state and local level generally. So some people, especially people that are more tax savvy, will use these as ways to generate income and pay less money in taxes. And the second thing you have to remember is that these accounts are not FDIC insured because you're not putting your money in a bank. So here, when you put your money into a bank, whether it's a high yield account, a CD, or a savings account, you have FDIC protection, which means if the bank were to go bankrupt, your money is protected up to $250,000. Beyond that, well, it's not necessarily protected, although we've seen government bailouts happen in the past. When you invest your money into a treasury, now you don't have that FDIC protection, but it's backed by the United States government. So if the United States government were to default and not pay back their bills, you wouldn't get your money back. But that's probably not going to happen, at least not in the short term. Instead, what the government is more likely to do is work with the central bank, the Federal Reserve Bank, to print money to pay back their bills, which means you'll get the money back. It just might not be worth as much money as before. All of that gets a little bit more technical, but the whole idea here is that the difference between these and these is here with treasuries, you're not actually putting your money in a bank. You're lending your money to the United States government and you're protected by the United States government. Here you're putting your money into a bank and you're protected by the FDIC insurance, which is also backed by the United States government. Now, while this interest sounds great, you need to compare the interest that you're getting on your money with the inflation rate in the United States. The reported inflation rate at the time when we were recording this video is right around 3% a year, which means on average, according to the reported numbers, the prices of things are going up by around 3%. Now, the key thing I want you to understand about this is, number one, if you are growing your money at a rate less than this, that means effectively you are becoming poorer because your money is growing, but it's not growing at the rate as the prices of things. So prices of things are getting more expensive faster than your money is growing. So you have your money in your savings account and it's not growing fast enough to keep up with inflation, so you're slowly becoming poorer. The second thing you want to understand is this reported inflation number might not be your real inflation number, because maybe you spend more money on groceries and your rent and your car than other people. And the inflation rate that many people feel, according to the general rule of thumb in the financial space, is that take this reported inflation number, multiply it by 2, and that is oftentimes the real inflation rate that many people are feeling. So if your money is not growing by 6%, well, then you might not be seeing your savings grow fast enough to keep up with the price growth of things that you are paying for. That's why it's so important to understand this, because many people have a lot of cash here. In fact, some people have all their investments here, thinking that they're doing the safe thing, when in reality, that safe thing can oftentimes be a guaranteed loss. And I also want to remind you that for those of you that are investors or want to become investors, I have put together a brand new free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. And I'll also share the exact framework that my firm and I use to research investment opportunities before they hit the headlines. It's completely free. There's a ton of value in this masterclass. So if you want to get the masterclass, all you have to do is click the link down in the description below to register. And when you do, you're also going to get access to Market Briefs, which is my newsletter for investors, completely free as a bonus, complimentary just for joining. So you can get the investing masterclass and Market Briefs all for free just by clicking the link down in the description. When I'm talking about assets in this video, I'm talking about stocks, real estate, investing in gold, investing in crypto, investing in startups. These are more risky than putting your money here, but with more risk, you also get more potential return. For example, historically, the stock market and the real estate market have grown by around 10% a year over the last 100 years. So that's definitely higher than the inflation numbers, which means when you put your money into those assets, assuming you find good investments, well, not only do you have the ability to keep up with inflation, but you're actually becoming wealthier because your wealth is now outpacing inflation. And if you're wondering, again, how do you invest your money? Remember, I just talked about that investing masterclass where I break it down all in there. But a couple of these assets, crypto and startups particularly, are much more on the speculative side, meaning they're more volatile. You can see big swings up and down, and you can have more risks because, well, when you invest in startups, many of those startups will fail. With cryptocurrency, it's a much newer asset class, and we don't know what it's going to look like in 20, 30, or 40 years, versus stocks and real estate have been around for many, many decades. Gold, on the other hand, is a little bit unique because I don't like to talk about gold as an investment per se. I talk about it as a way of saving hard money, but gold has been seeing a very strong bull run since 2020, meaning it has gone up a lot since the 2020 pandemic, and a lot of people are very excited about this movement in gold. Just understand that unlike stocks and unlike real estate and unlike startups, that gold isn't actually producing value. It's not going out and producing a profit. It just sits there and looks back at you. Not saying it's a bad thing, but understanding how it plays a part in your investment portfolio because it is different than other investments. And this is where many people, especially high income earners who want to be financially savvy, get a little confused because they don't know what to do with their money. You're making a lot of money. Maybe you're a doctor. You're making a few $100,000 a year and you live small. So you have all this extra cash, so what do you do with it? Well, you don't want to invest it because you don't know how to invest. You've never invested your money before, so you just keep saving that money. And it's better to save that money than buy a whole bunch of stupid stuff. But now you're saving that money, and this is where a lot of times people don't realize that you're actually getting hurt because you're saving that money here and you're getting a little bit of return, which is nice, but you're actually losing relative to inflation. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.